You finally embrace financial responsibility. You've mastered the art of the monthly budget, successfully setting aside a portion of your paycheck, perhaps $150 or $250 at a time. You feel a sense of pride, discipline, and newfound maturity. However, a year later you check your digital banking dashboard only to find a peculiar reality. Your hard-earned $10,000 has been sitting in a traditional savings account with a meager 0.5% interest rate. After 12 months of discipline, your reward is a mere $50. Meanwhile, the headlines are filled with stories of index funds, compound interest, and market growth. You start to feel a nagging sense of unease. Are you actually losing ground by being safe? The truth is that while saving is an essential foundation, it is rarely the vehicle that drives you to true financial independence. Most people find themselves trapped in this saver's paradox.
They understand that keeping money is vital, but they lack the roadmap to transition that capital into productive assets. This guide is designed to bridge that gap, offering a clear, methodical strategy to evolve from a passive saver to a confident investor without compromising your financial peace of mind or feeling like you're gambling with your future. The fundamental difference: protection versus production. To begin this journey, we must address a reality that might feel counterintuitive. Saving money in isolation will almost never build significant wealth. This is because saving and investing serve two entirely different purposes. Saving is meant for protection. Its job is to ensure your money is there when you need it. Investing, conversely, is meant for production. Its job is to make your money work for you. To understand the weight of this difference, look at the historical data. If you keep $10,000 in a standard account at 1% interest, you'll have roughly $12,200 after 20 years. While your principal is safe, its purchasing power has likely been eroded by inflation. Now, consider the historical average of the stock market, which has returned roughly 10% annually over long durations. That same $10,000, if invested, could potentially grow to over $67,000 in those same 20 years. The starting amount is identical, but the destination is worlds apart. The greatest divide in modern wealth isn't just between those who spend and those who save. It is between those who simply hoard cash and those who deploy it into the market. Overcoming the safety barrier. If the math is so compelling, why do so many people hesitate? The answer isn't a lack of intelligence. It's a matter of psychology. Humans are hardwired to avoid loss. Saving feels secure because the numbers on the screen don't change, except to go slightly up. Investing feels volatile because the market breathes. It fluctuates, and seeing a red day can trigger an emotional panic. To navigate this, you shouldn't view the transition as a blind leap into the unknown. Instead, it should be treated as a structured evolution. You don't go from a piggy bank to high-frequency trading overnight. You move through specific, manageable checkpoints that minimize risk and maximize your comfort level. Step 1. Secure your foundation with a resilient emergency fund. Before you even glance at a brokerage account, you must build your financial moat. This is an emergency fund containing 3 to 6 months of essential living expenses. This capital must remain in a liquid, accessible savings account. It is not for buying the dip or seizing opportunities. It is strictly for the unexpected: medical bills, car repairs, or sudden unemployment.
The primary reason many novice investors fail is that they are forced to sell their investments during a market downturn because they didn't have enough cash on hand. An emergency fund acts as a psychological buffer. When you know your rent and groceries are covered for the next half year, you can watch the stock market fluctuate without the urge to panic sell. Step 2. Compartmentalize your capital. A vital mental shift involves separating your money into two distinct buckets. Bucket 1 is your security bucket, which houses your emergency fund and any money you need for short-term goals, like a vacation or a house down payment in 2 years. This money is meant to stay static. Bucket 2 is your growth bucket. This is capital you don't intend to touch for at least 5 to 10 years. By mentally labeling this money as growth, you give it permission to be volatile. You accept that it might go down today so that it can be significantly higher a decade from now. This separation dramatically lowers the anxiety associated with market movements, because you know your day-to-day survival isn't tied to the S&P 500's daily performance. Step 3. Embrace the power of small habitual starts. One of the most persistent myths in finance is that you need a fortune to start investing. In reality, the habit is far more important than the amount. Most modern platforms allow you to begin with as little as $50 or $100. The goal of your first few months of investing shouldn't be to get rich. It should be to get started. By starting small, you desensitize yourself to the rhythm of the market. You learn how it feels to see your balance move up and down by a few dollars. This builds the emotional muscle memory required to handle much larger sums later in life. Remember, time in the market is a much more powerful predictor of success than trying to time the market. Step 4. Prioritize simplicity over sophistication. New investors often fall into the trap of complexity. They hear about day trading, options, or the newest speculative digital currency and think that is what investing looks like. However, some of the most successful investors in history, including Warren Buffett, advocate for the simplest path: low-cost index funds. An index fund is essentially a basket of hundreds of different companies. Instead of gambling on whether one specific company will succeed, you are betting on the collective growth of the entire economy. This provides instant diversification. If one company in the fund fails, the other 499 can carry the weight. It is a boring strategy, but boring is often what pays the bills over 30 years. The extraordinary math of consistency. To see the true potential of this path, consider a slow and steady approach. If you were to invest $300 a month into a diversified portfolio with an average 8% annual return, after 25 years your portfolio would be worth approximately $285,000. Out of that total, your actual out-of-pocket contributions were only $90,000. Nearly $195,000 of that wealth was created by the market through the power of compounding. This is where the analogy of the seed versus the soil comes in. Saving money is like keeping seeds in a dry jar. They are safe and they won't rot, but they will never become anything more than seeds. Investing is the act of planting those seeds in fertile soil. It requires patience, and sometimes the weather is bad. But given enough time, those seeds grow into a harvest that can sustain you
for a lifetime.
Navigating the storms. Inevitably, the market will crash. It is a historical certainty. However, for the long-term investor, a market downturn is not a disaster. It is a discount. Through a process called dollar-cost averaging, your fixed monthly investment buys more shares when prices are low. When the market eventually recovers, those extra shares act as an accelerator for your returns. Experienced investors don't view a dip in the market with fear. They view it with the perspective of someone who is shopping for a future they haven't reached yet. They stay focused on decades, not days.
Summary: your path to financial freedom. To recap the journey from stashing cash to building a legacy, construct your safety net. Ensure your 3 to 6 month emergency fund is fully funded. Organize your mindset. Separate your cash into security and growth categories. Start immediately, however small. Focus on the discipline of the monthly contribution. Stay simple. Lean on diversified index funds rather than speculative get-rich-quick schemes. Practice patience. Allow the math of compounding the time it needs to work its magic. Ultimately, saving provides you with stability, which is necessary for peace of mind. But investing provides you with freedom, which is necessary for a life of choice. By combining the discipline of a saver with the vision of an investor, you aren't just protecting your present, you are funding your future. The best time to start was years ago. The second best time is today. Your future self will thank you for the seeds you plant now.
All right, let's get real for a second. I want to show you the
Simplicity
actual
wins.
cost of playing it
Tools like
too
Vanguard's
safe.
VOO or
Look at
Fidelity's
this.
Total Market Funds
If you leave
allow you to own a piece of the
$10,000 in a
500
standard
biggest companies in
U.S.
the
savings
US
account,
with one click.
after a decade,
You're not
you've
gambling on a
barely
single
made enough
stock.
for a nice
You're
dinner.
betting on the American economy.
But look at what
It's boring,
happens
it's
when we plug
consistent,
that same
and it
amount
works.
into a basic S&P 500 index fund at a historical 10% return. That is the wealth gap in action. And this is why your environment matters. You don't need to be a Wall Street genius. For most of us in the States, simplicity wins. Tools like Vanguard's VOO or Fidelity's Total Market Funds allow you to own a piece of the 500 biggest companies in the U.S. with one click. You're not gambling on a single stock. You're betting on the American economy. It's boring, it's consistent, and it works.